Something just changed in crypto regulation that matters more than it looks. After years of uncertainty, Washington is moving towards rules that could redefine how digital assets are regulated, traded, and adopted across the U.S. financial system. The outcome could affect exchanges, institutions, and projects that have spent years operating without clear legal boundaries. In the next few minutes, we'll break down what the Clarity Act actually does, why it becomes one of the most important crypto bills in U.S. history, and why XRP sits at the center of a debate that extends far beyond a single digital asset. For more than a decade, the crypto industry has grown without a clear legal framework. Billions of dollars entered digital assets while one fundamental question remained unresolved. What exactly is a crypto asset? Is it a security, a commodity, a payment network, or does it require an entirely new regulatory clarity? That uncertainty has influenced nearly every major decision in the industry, from exchange listings and institutional custody to venture capital investment and where blockchain companies choose to build. Now, lawmakers are attempting to answer those questions through the Clarity Act, legislation that supporters believe could establish the first comprehensive framework for digital assets in the United States. Critics, however, argue it could reshape financial markets in ways that are still not fully understood. At the center of that discussion is XRP, baby, a digital asset that has spent years at the heart of one of crypto's most consequential legal battles. But this story isn't just about XRP. It's about how regulatory clarity could influence institutional participation, banking, innovation, and whether the United States can remain competitive in an increasingly digital financial system. Ladies and gentlemen, if you want the satellite perspective on XRP and crypto and want to cut through the daily chaos and noise, subscribe to the channel. I break it down simply so you can see what actually matters in this market. See, for years, the cryptocurrency industry has faced a problem that many traditional industries never encountered. Innovation arrived long before regulation. Companies launched exchanges, developers built decentralized networks, and institutions began experimenting with blockchain technology. Investors poured hundreds of billions of dollars into digital assets. Yet one question remained unanswered. Who regulates what? Depending on the agency, the answer often changed. The Securities and Exchange Commission argued that many digital assets should fall under securities law. Meanwhile, the Commodity Futures Trade Commission maintained authority over certain crypto commodities and derivatives. Market participants frequently found themselves navigating overlapping jurisdictions, evolving guidance, and legal uncertainty. That uncertainty has influenced nearly every major decision in the industry, from exchange listings to institutional custody, venture capital investment, and even where blockchain companies chose to establish headquarters. Now, this is what most people miss. Markets don't only react to regulation, they react to clarity. Businesses can adapt to strict rules. They struggle far more when the rules remain uncertain. That distinction is one reason why investors, financial institutions, and industry participants are watching the Clarity Act so closely. See, ladies and gentlemen, at its core, the proposed legislation attempts to answer a question that has divided regulators for years. How should digital assets be classified? Rather than relying exclusively on laws written decades before blockchain technology existed, supporters argue that legislation would establish a framework designed specifically for digital assets. Among the key areas under discussion are clear definitions for different categories of crypto assets, regulatory responsibilities shared between agencies, oversight for digital asset markets, rules affecting stablecoins and related infrastructure, disclosure requirements, custody standards, enforcement mechanisms. See, supporters believe this could reduce years of regulatory uncertainty. Critics, however, continue debating how much authority should belong to each regulator and whether the proposed frameworks strike the right balance between innovation and investor protection. See, those disagreements have turned the legislation into both a financial debate and a political one. See, financial legislation rarely exists in isolation. Every major reform reflects competing priorities: consumer protection, economic competitiveness, national security, innovation, market stability. The debate surrounding crypto has become another example of those competing objectives. Some lawmakers argue that failing to provide clear rules risks driving innovation overseas. Others believe stronger safeguards should come first before expanding access to digital assets. Political negotiations have therefore become almost as important as the legislation itself. Analysts continue watching whether compromises can be reached on issues including supervisory authority, enforcement powers, and ethic provisions. But here's where it gets interesting and spicy. Regardless of which political party supports or opposes specific provisions, one trend appears increasingly difficult to ignore. The conversation has shifted and changed. The debate is no longer whether crypto exists. The debate is how it should be governed. That represents a significant change from only a few years ago. See, ladies and gentlemen, history offers an important reminder. After the stock market crash of 1929, confidence in American financial markets collapsed. Investors questioned whether markets could ever become trustworthy again. In response, the United States introduced landmark security reforms during the 1930s, including the Securities Act of 1933 and the Securities Exchange Act of 1934. Those reforms didn't eliminate risk, ladies and gentlemen. Markets still experience booms. Markets still experience crashes. But something fundamentally changed. Investors finally understood the rules. Disclosure requirements became standardized. Oversight became clearer. Confidence gradually returned. Today's digital asset industry faces a very different technological challenge, but the underlying principle is surprisingly familiar. See, markets often mature not because uncertainty disappears, but because the rules become more predictable. See, among major cryptocurrencies, XRP, the anointed one, occupies an unusual place in regulatory conversion. Unlike many digital assets that have never been the subject of extensive federal litigation, XRP became central to one of the most closely watched legal cases in crypto history when the SEC sued Ripple in 2020. Subsequent court filings and rulings provided important legal findings regarding certain XRP transactions, although they did not create a comprehensive regulatory framework for every digital asset or every possible transaction involving XRP. See, as a result, many market participants view XRP as having a greater degree of judicial guidance than numerous other cryptocurrencies. That distinction has fueled ongoing discussion among investors. Some believe clear legal treatment could make XRP more attractive for institutional use. Others argue that broader legislation, not individual court decisions, will ultimately determine how the digital asset industry develops. Either way, XRP remains one of the most closely monitored assets whenever regulatory developments emerge in Washington. But one of the most significant developments has come from an unexpected direction. Traditional banks. So years ago, many viewed cryptocurrency as a direct competitor to the banking system. Today, the relationship is becoming more nuanced. Major banking organizations have increasingly acknowledged that digital assets are likely to remain part of the financial landscape. Rather than opposing regulation outright, many institutions support comprehensive frameworks that establish clear operating standards. However, that support often comes with conditions. Banks continue expressing concerns about maintaining financial stability, ensuring consumer protection, and avoiding unintended consequences that could disrupt traditional lending markets. One area receiving particular attention involves stablecoins. If digital dollars become widely adopted and begin offering competitive yields, some financial institutions worry that deposits could migrate away from commercial banks. That could influence liquidity and lending capacity. As a result, banking groups have emphasized that regulation should encourage innovation while preserving the broader financial system. This isn't simply about crypto versus banks anymore, ladies and gentlemen. It's increasingly about how both systems might coexist. While lawmakers debate regulation, another issue continues attracting attention: security. Recent industry reports indicate that compromises involving private keys remain one of the largest contributors to cryptocurrency theft. That statistic highlights a difficult reality. Owning digital assets provides unprecedented control, but it also creates unprecedented responsibilities. Lose access to private keys, and recovery may be impossible. If keys are stolen, funds can often move almost instantly. As institutional participation grows, security infrastructure becomes increasingly important. Large custodians have responded by developing institutional-grade custody services featuring multiple authorization layers, operational control, insurance arrangements where available, and compliance procedures designed for large organizations. Self-custody remains an important principle for many crypto users, yet institutional investors often prioritize operational resilience, governance, and risk management over complete individual control. That evolution reflects the industry's broader evolution. Think of today's crypto industry like the early railroad networks during the Industrial Revolution. Building the tracks was only the beginning. Without standardized gauges, Safety rules, operating procedures, and shared infrastructure expansion remained fragmented. As standards gradually emerged, isolated rail lines transformed into interconnected national networks that reshaped commerce. Digital assets may be experiencing a comparable transition. The technology already exists. Now the focus is shifting towards the rules, infrastructure, and institutions needed to support broader adoption. Short-term headlines may drive market volatility, but long-term structure often determines whether innovation becomes part of everyday economic life. So where does all this leave the Clarity Act? Political negotiations continue. Regulators continue redefining their positions. Banks continue preparing for a future where digital assets become increasingly integrated into financial markets. Investors continue weighing every new development coming out of Washington. And while markets naturally focus on short-term price movements, something much larger may be unfolding. The rules that govern digital assets could reshape institutional adoption, investment decisions, and the competitive position of the United States for years to come. Because this isn't simply a debate about one cryptocurrency. It's a debate about how an entirely new financial infrastructure fits into the world's largest economy. And as we'll see next, the story becomes even more fascinating once ethics, rules, global competition, and institutional adoption enter the picture. As lawmakers debate market structure, another issue has quietly moved into the spotlight. Ethics. Let this sink in, ladies and gentlemen. One of the more closely watched aspects surrounding digital assets legislation is whether elected officials and senior government leaders should face stricter rules regarding cryptocurrency ownership and financial disclosures. Supporters argue that if lawmakers help shape policies affecting billions of dollars in digital assets, the public deserves confidence that those decisions are being made in the public's interest, not influenced by personal financial gain. Others caution that any ethics frameworks need to be applied consistently across all asset classes, not just cryptocurrencies. Regardless of where the debate ultimately lands, the discussion reflects something much bigger. Crypto has become important enough that governments are beginning to treat it like other major financial markets, where transparency and conflicts often interest matters just as much as rules themselves. That alone makes and marks a significant shift from the industry's early years. See, while Washington continues debating legislation, other countries are already moving ahead. One market attracting attention is South Korea. For years, South Korea has been one of the world's most active cryptocurrency markets. Unlike many Western markets where Bitcoin often dominates trading actively, South Korean investors have historically shown strong interest in alternative digital assets, including XRP. Trading volumes periodically demonstrate just how diverse global crypto demand has become. This matters because cryptocurrency has never been solely an American story. Capital moves across borders. Innovation moves across borders. Talent moves across borders, ladies and gentlemen. If one jurisdiction creates an environment viewed as more predictable, companies and investment often follow. Now, this is what most people miss. Regulation is no longer just about protecting investors. It's also becoming a competition between countries seeking to attract innovation, capital, and financial technology companies. The competitive dynamics is influencing policymakers around the world. Retail investors often focus on one question: will this make price go up? Institutions tend to ask a very different question: can we operate within the rules? Large pension funds, asset managers, banks, insurance companies, corporate treasuries, these organizations manage enormous pools of capital. Before allocating significant resources to any emerging asset class, they generally look for predictable legal frameworks, reliable custody solutions, operational standards, and clear compliance obligations. That is one reason regulatory clarity receives so much attention. It doesn't eliminate investment risk, but it reduces uncertainty surrounding participation. Many analysts argue that mature markets are built less on speculation and more on confidence in the underlying rules. Prices reacting, systems evolving. History offers another useful perspective, ladies and gentlemen. During the early years of the internet in the 1990s, many people recognized the technology's potential. Yet widespread commercial adoption did not happen overnight. Businesses needed legal certainty surrounding electronic contracts. Consumers needed confidence in online payments. Companies needed standards for digital commerce. As those legal and technology frameworks gradually developed, entirely new industries emerged. E-commerce expanded. Digital banking accelerated. Online marketplaces transformed global trade. The internet itself didn't suddenly become more powerful. The surrounding infrastructure matured. Supporters of clearer digital asset regulation believe blockchain technology may be approaching a similar phase where the next stage of growth depends as much on governance and standards as on technology and innovation. One of the biggest questions investors continue asking is surprisingly simple. What happens if comprehensive legislation takes longer than expected? Some observers point to ongoing collaboration between regulators, including the SEC and the CFTC, as evidence that regulatory governance and guidance may continue evolving even without a single comprehensive law. Others have highlighted initiatives aimed at providing clearer guidance on areas such as digital asset custody, staking, market oversight, and token classification. The path could look different. The timeline could change, but many analysts believe the broader direction remains the same. Governments around the world are steadily developing more detailed frameworks for digital assets. Exactly how those frameworks evolve remains uncertain. The movement towards greater regulatory clarity, however, appears to be continuing. Short-term noise, long-term structure. But while regulation receives most of the headlines, security may ultimately prove just as important. See, every major financial system depends on trust. Traditional banking relies on vaults, compliance systems, insurance, and decades of operational safeguards. Digital assets require their own version of that infrastructure. Recent industry data has highlighted that significant role that compromised private keys continue to play in cryptocurrency theft. For individual investors, that reinforces the importance of understanding how digital assets are stored and protected. For institutions, it reinforces why custody providers, cybersecurity specialists, and operational controls are becoming central pieces of the ecosystem. As adoption grows, investors are likely to evaluate crypto platforms not only by the assets they offer, but also by the strength of the system protecting those assets. Infrastructure rarely makes headlines, yet history repeatedly shows that strong infrastructure often determines whether new technologies achieve widespread adoption. Imagine constructing a modern city, ladies and gentlemen. The tallest skyscrapers attract the attention, but those buildings only function because of the unseen foundation beneath them. Water systems, electrical grids, transportation networks, building codes. Without those invisible systems, even the most impressive skyline cannot endure. Today's cryptocurrency industry may be experiencing something similar. Prices capture attention. Infrastructure creates permanence. The market naturally celebrates innovation. But the long-term success often depends on the less glamorous work happening underneath: regulation, custody, compliance, security, and institutional standards. Those foundational elements rarely dominate social media discussions, yet they may prove to be the most important developments of all. For XRP, the broader regulatory conversation carries particular significance. The asset has already experienced years of legal scrutiny, making it one of the most closely watched cryptocurrencies. Whenever U.S. policy evolves, if lawmakers or regulators continue moving towards clear definitions for digital assets, investors will likely evaluate XRP within the broader framework rather than through isolated headlines alone. Some market participants believe greater regulatory certainty could encourage additional institutional participation across the digital asset sector. Others emphasize that adoption will ultimately depend on real-world utility, technological development, market demand, and competitive dynamics, not regulation alone. That distinction is important. Regulation can establish the rules of the game. It does not determine the winners. Markets still respond to innovation, execution, adoption, and economic conditions. It's easy to become distracted by daily price charts. Yes. One announcement, one hearing, one headline, one social media post. Those events create volatility, but they don't always define long-term direction. When historians eventually look back at this time period, they may spend less time discussing individual price movements and far more time examining how governments, financial institutions, and technology companies collectively built the regulatory foundation for an entirely new asset class. That process is rarely fast. It's often political, sometimes frustrating, occasionally unpredictable, but it's also how financial systems evolve. The cryptocurrency industry is gradually moving from experimentation towards integration, not replacing traditional finance overnight, ladies and gentlemen, not eliminating institutions, but increasingly becoming another component of the global financial system. So when the Clarity Act becomes law in its current form or evolves through future negotiations, one reality is becoming increasingly difficult to ignore. The conversation has fundamentally changed. The question is no longer whether digital assets deserve a place in the financial system. The question is how they will be integrated into it. Banks are adapting. Regulators are redefining their approaches. Institutional investors continue watching closely. Technology continues advancing, and markets continue responding to early new developments and every development. No single piece of legislation will determine the future of cryptocurrency. No single court case will define an entire industry. No single asset will represent the outcome of this transformation. Instead, the evolution of digital assets will likely be shaped by thousands of decisions made over many years by lawmakers, regulators, developers, financial institutions, businesses, investors worldwide. Because throughout financial history, lasting change has rarely happened overnight. It has happened one regulation, one institution, one innovation, and one decision at a time. The coming years may reveal whether today's debates become the foundation for tomorrow's financial system. Whatever happens next, one thing's becoming increasingly clear. The crypto market is no longer asking whether regulation is coming. It's asking what the regulation will ultimately look like. And that answer could shape the future of digital finance for decades to come. If you've enjoyed this deep dive and want more analysis on crypto regulation, macroeconomic trends, institutional adoption, and XRP, be sure to subscribe to the channel and turn on notifications. Thank you for watching. I'll see you in the next video. Hope everyone's having a blessed afternoon, ladies and gentlemen. I want to welcome all the new members of the Patreon, the Crypto Public Desk Monthly, all new members in the membership channel. Recapping everything. Once everything is dialed in, that we have the narratives and we see the patterns in the narratives that shape price movements, being a financial mercenary gets easier and easier and easier. Like I said, death from 1,000 tweets. From our last video, if you look at where silver going, silver is going exactly to the points that we were talking about. You have to love this because the narratives aren't changing. The whole world right now is wondering if there's going to be a much bigger blitz against Iran, the Houthis, as this conflict widens. It's expanding in the Caspian Sea. It's expanding in the Red Sea. This is going to create volatility. Volatility creates returns, ladies and gentlemen. Last time this kicked off, members of the Crypto Public Desk Monthly saw anywhere between 50 to 150% returns on the money, depending on what tip from the pits that they decided to take. One solid tip, ladies and gentlemen, can pay for your entire year's subscription. Again, come and join over 630 active traders and investors who are learning to take advantage of the volatility, because volatility is the long-term accumulator's best friend. Learn how not to get caught up like sushi. Again, from last video, silver's in play. Gold, still long Bitcoin. But again, chaos is coming. One way or another. You can be on the sidelines or you can be in the game. This is not financial advice. This is just my own opinion. This is for you, David. I'm going back to the tranches with the east and west side of the tranches. You got to understand something right now. Whether this passes now or before the midterms, we're in the camp that it gets passed in some shape or form. If not, there's plan B, that they're going to write laws, the SEC, regardless. You got other countries moving forward. This is not going to stop. You got investment companies and banks are going to continue building. How much institutional capital gets applied to it is the only thing that is the remainder and the big question here right now. But you got to understand something. If you look at the world, the main thing is the financial war going on right now. As the Remora, we're going to feast on everything, right? You got physical gold trading evolving in Hong Kong, China. I mean, the real estate market there is just booming. You got a lot of family offices and funds going over to Hong Kong. It's booming over there. But ask yourself this question. You think the debt regime on the western side of the tranche is just going to allow this to happen? No. If anyone thinks that they're going to allow this to happen, I have a bridge to sell you, okay? So you got to get excited for the process. I tell you all the time to pay attention to what's quiet. Investing for the long run is like watching paint dry on the wall. It really is. It's super boring till it's not. That's why we don't get caught up like sushi. We don't FOMO. We don't FUD. We have a plan. Crude oil goes higher. RBOB hits 420. Talks. Things drops. Higher energy leads to expectations of higher Fed raising. The 30-year is the highest it's been in a long time. I've told you before, there's two ways to fight inflation. Short-term rate hikes or the yield on long-term treasuries. The problem with the long-term plan, ladies and gentlemen, here's a nice factoid. Write this down for all you haters. I love my haters. I love you guys. I do. Keep bringing the hatery. The whole world is in this AI war, right? Who do you think borrows money on a 30-year? Who? companies to finance all the things they're doing in AI, besides issuing more stock. Normally, companies are buying back their stock. They're spending as much as they can to get an edge in the AI wars. It's an energy war. If you follow our recce of everything that we have here, it makes sense where we're going. You want to complain all day? XRP went down today. Sell it. Throw a towel. Ring the bell. Bye-bye. Thank you for playing. Seriously. We'll complain right here. I like to have discussions with people that are pissed off. You know why? A few years from now, sooner than that, when print and winter begins, because it has to begin. Because liquidity has to come back into the market. There's no liquidity here right now. And when it does, the rip your face off rally is going to begin. And people are going to remember this lunatic here at this channel, me, screaming and ranting and raving. Don't give up your lottery ticket. Don't do it. You worked hard. You accumulated. You DC'd. You did everything right. XRP and Ripple continue to build infrastructure every day in this ecosystem. It's magnificent. Magnificent. ICP's time's coming. It's magnificent what's happening. The agentic economy is going to come, ladies and gentlemen. You and I can't stop that. The same way, look, POTUS outlawed all humanoid-type robots from China. It's happening now. But if you want to take advantage of the volatility when the DXY spikes, when crude oil spikes, silver, gold, platinum, palladium, cryptos, come and join the Crypto Public Desk Monthly, ladies and gentlemen. Join over 600 active traders, investors, because this is going to kick off, and we're in the camp that they're going to be some rough times coming in this conflict. There's going to be some bombings that are coming, and we're in that camp, and it's going to move the market. Ladies and gentlemen, don't get caught up like sushi here. Don't FOMO this. But if you want to learn how to harness the volatility and see the gains that the Crypto Public Desk Monthly members are seeing, come and join the Crypto Public Desk Monthly, ladies and gentlemen. It's that simple. But don't get caught up like sushi. None of this is financial advice, just my opinion. Never, ever invest any capital based on watching a YouTube video. Always consult a licensed financial advisor. This video is for entertainment and educational purposes only. This is not financial advice. Nothing I say in this video is financial advice whatsoever. Never invest any capital based on watching a YouTube video, ever. Never do that. I love you all, ladies and gentlemen. I'll see you in the front lines. And if you want to get involved, come and join the Crypto Public Desk Monthly. But if you took that silver play that I was talking about, move your stops. Move your stops to break even, because our first target's around 60, 59 and change is coming. You're going to want to move your stops now to break even if you're in that position that I just say here. We're still long Bitcoin, still long gold. But again, the market tells a tale. It's a map. Once you can read the map, this is what I learned on the floor of the New York Mercantile Exchange. Ladies and gentlemen, once you learn this, the volatility is your best friend in this market. Take advantage of the volatility in all asset classes to build your stacks of high society to keep adding to your crypto positions. Because we will look back on this. We will look back on this and say, I can't believe how low XRP was. I love the XRP haters. I do. I love that. I really, really do. I do. I love you all, ladies and gentlemen. I'm going to see you on the front lines.